Well, we're here again on a Monday after a high on Wall Street of a closing on Friday. So, Mark of Vere Global Financial, the CIO of Vere Global, it closed high Friday on Wall Street, and Monday, today, it closed high as well. So, again, are we seeing a trend? Has it bottomed out? Are we going up? Or is it still too crazy to tell what's going on?
Well, there's an old saying on Wall Street, don't fight the Fed. And it seems like the Fed just keeps on pumping money into the economy to try to get it going. On Friday, we had the unemployment numbers came out and the market skyrocketed. And then during the middle of the day, the Labor Department actually said they actually made a mistake and the unemployment rate should have been 3%, 3 percentage points higher than what it actually was. But because the Fed keeps pumping so much money into the market, it just keeps going up. Kind of also give you an example, and I think this comes down to the Fed. The Fed knows what they're up against, and they're kind of scared. Give you an example. If you go back to the housing market, the housing market was roughly in 2007 about a 12 trillion to 15 trillion dollar market. And the Fed, when that came crashing down, you saw what happened to the stock market and the economy.
Yeah.
The bond market is in the exact same situation today as the housing bubble was back in 2007. The bond market is a $40 trillion market. If the Federal Reserve loses control of that 40 trillion, it's game over for the U.S. economy. There is no recovering from that because in the housing market, there's a certain price your home's going to fall to. It may fall from, a $200,000 home down to a $10,000 home, but there's an intrinsic value, the real estate, the wood of the house.
Right.
There's a point it'll never fall. With a bond, when a bond goes bankrupt, theoretically, that $40 trillion could go poof up in smoke like that, and it's gone. And we're only in a $20 trillion economy. You're talking double the economy gone, poof.
And you're saying that's an increasing possibility?
It's an increasing possibility because when the Fed lowers interest rates, what does everybody do? They go out and take on more debt. Companies issue more debt.
Right.
And that debt, and then we're in a debt bubble right now. It's keep getting bigger and bigger and bigger. And just to give you an idea of it, if you go out and buy a 10-year Treasury bond right now, a 10-year Treasury bond yields 0.87%. The inflation rate's running at 2%. So if you buy a Treasury bond right now, you're guaranteed to lose money in inflation. And the Fed has to keep the bond market from crashing because once it crashes, it's game over. Now, the big question is, can they prevent it from crashing? That's going to be the big question.
Now, Mark, another factor that's pumping up the market artificially is the amateur investors, the retail investors that are still going gung-ho on stocks that they're buying low in the hopes that they're going to be able to sell it as it goes way back up, correct?
That's correct. A good example of that is Hertz Global, the rental car company. The car company filed for bankruptcy last month. And just 2 weeks ago, it was trading for 55 cents a share. Now it's trading for over $4 a share. It was up 115% today, and the company's bankrupt. And what's the ironic thing about it is Hertz is in such bad situation, it's selling its cars off to try to pay its debt. So you're essentially buying a rental car company that won't have any cars to rent. Now, people like me, we'll never touch Hertz because we know what the end result is. But that hadn't stopped the stock from going up 800%.
But the amateur investors are saying, well, it's an established car company. As the economy opens back up, people are going to be renting cars again, so the stock is going to go way back up and I'll make a killing. What is wrong with that logic?
Well, it's a great logic because people will be renting cars and they will be traveling again. But again, Hertz is in such bad shape, they're having to, because the banks are wanting their money from their loans, they're having to sell their cars at discount rates. The rental car company won't have any cars to rent.
And they won't have any money to buy more cars to rent as the economy opens up again?
Would you loan money to Hertz right now?
Good point. Good point. Now, you're also saying another factor here, very, very unusual, is that the amateurs that we're talking about, the retail investors, the guys who think that they've got a real beat on the market and know more than the professionals, they're actually forcing the professionals, people such as yourself, although I know you're not on board with it, but they're forcing a lot of professionals to go along with bad investments because that's what they want, correct?
That is correct. A lot of people right now in my industry are being forced with clients saying, hey, you've been sitting in cash, you've been defensive, you need to get me in the market. So the professional are sitting back, I can either put my client in the money and he loses money in the market, but the client will be happy, or I can keep the client safe and protected, and the client's going to get angry and leave anyway. So they're jumping into the market, and trying to chase returns.
So this is largely then a bubble, if I'm reading you correctly. It's still a bubble that is going to burst.
It is a bubble, and that's the big question on when it will burst. I mean, if you go back and look at the housing market bubble, people that knew what I knew, you started seeing some very serious problems back in 2005. If you watch the movie The Big Short that talks about those guys that made a killing on the shorting the housing market,
Yeah.
a lot of people don't realize this, but they started making their bet on the housing market going bankrupt in 2005 and 2006. They lost money in 2005, 2006, and even 2007. They didn't start making money until almost the middle of '08. But the market can be wrong longer than you can remain short.
So, Mark, what's going to happen? I mean, what we're saying is eventually we got a bunch of crazies on Wall Street now doing all kinds of unwise investments, giving unwise investment advice. You got all kinds of investment apps that the amateurs are looking at. So it's really being driven by crazies.
It's correct. Robinhood tends to be the most popular app right now. And if you pull, you can actually look at the most popular trades through Robinhood. It's a trading app for millennials. Hertz actually ranks in the top 2 of the most popular traded stocks, and is one of the research firms on Friday said obviously they don't teach accounting in Sherwood Forest because everyone's buying Hertz.
All right. So now, how about this argument that I've heard from time to time? Classic argument, actually, that reality, the perception is the reality. So if the perception is that we're heading towards a tremendous recovery, the stock market is about to come roaring back, if that's the perception driving the market, does that not become the reality?
That is correct. The Fed's goal here is if they can keep the bond market alive long enough until the economy can get going again, the theory is the growing economy will be able to basically fix the bond market over the long term. But
that's the theory.
That's the theory. But what they're doing is they're creating moral hazard, because now, as they've seen with, the Fed's gone in and bought bonds, the Federal Reserve was buying Hertz bonds a few weeks ago. Those bonds are now bankrupt. So your tax dollars are now lost in that. So what they're basically showing people, if you take on more risk, well, the Fed's going to come in and bail you out, like with Hertz. I mean, so their theory is simply begetting more problems, because as they see the Fed has their back, people will take more and more risk. I mean, look at the people again, going back to Hertz. Hertz made, I think that in the last 2 weeks, Hertz has paid out $16 million in bonus checks to executives who basically rolled the dice. The Federal Reserve came in and bought Hertz bonds to prevent the company from going bankrupt, but the company still went bankrupt with your tax dollars, and the CEOs and CFOs walked away with $16 million in bonuses. In a few more years, everybody should be doing that. You should start a business and let the Fed come in and bail you out. I mean, I'm in the wrong business. I need to start a business and have it go bankrupt and have the Fed come bail me out. That's what I really should be doing.
All right. So, but, there's also the argument and the reality that the Fed could endlessly print money so they could keep it propped up perpetually. No?
Well, yes and no. But if you continuously print money, eventually you cause inflation. And then we go back to the problem, if you buy a bond now and it's trading below the inflation rate, well, maybe someone can eat it up a little bit if you're buying a bond at 1% and the inflation rate's at 2%, but start putting the inflation rate up there at 6, 7, 10% like we saw back in the 1980s. Do you really want your money sitting in a bond having an annualized loss of 10% per year? So it's a very tricky game they're playing here.
So, Mark, what's the upshot? I mean, what are we headed into? Are we headed into any kind of recovery, or are we going to wade into a continuing and perhaps a deepening recession or worse? What's your forecast?
I think we'll recover from this round, but the problem is what happens on the next round. The Federal Reserve has thrown the kitchen sink, the entire house, and everything at this problem. Let's say in 3 or 4 years from now, let's say we have another disease breaks out, or there's another housing bubble, or whatever, or we just go into a natural recession. Will the Fed have enough power to go in and actually to put enough support to keep it from crashing? Right now the Federal Reserve's balance sheet is at $7 trillion. The estimate is they will hit $10 trillion by the end of this year. The U.S. government is going to issue another $800 billion worth of Treasury bonds in the next few weeks. to pay for all of this money that they have done with this COVID release plans. That's another $800 billion coming to the market.
And how much of a factor now is the looting and the destruction from the rioting? Is that a significant economic factor in keeping the recovery dampened?
I think it'll have a minor impact. Some businesses that were probably on the borderline of being able to recover from the COVID-19, if their business got burned down, it's going to be a game changer for them now. They just won't be able to recover with COVID and a burnt business. They can survive one or the other, but they can't survive both of them.
But overall, in the big picture, that is still not such a significant factor.
No, riots, if you look back through riots through history, I think Fox News actually got in trouble last week. They actually showed that you go through and look at riots over the past 50 years.
Yeah.
The market actually gone up on average by 3%, and that includes things like the Martin Luther King assassination, the Kennedy assassination, the Rodney King beatings, and they got into a lot of trouble for that because it basically shows the stock market has no morals, which is correct. Wall Street has no morals.
So Fox got in trouble, but they were reporting it correctly.
That is correct.
All right, so last question, my traditional last question to you. You're a financial advisor. You invest money for people, for your clients. What are you telling them these days?
Well, right now I tell them, let's go ahead and just keep, I like to tell people we ride the horse. We don't get off the horse, which is the stock market, until it stops moving. We know that these problems exist. We will ride the stock market as long as we can. We'll try to take advantage of opportunities here and there, but we know at some point we're going to have to sell stocks. That might be next week, might be 3 years from now, but we always keep our fingers on the button, knowing that when the match hits the kindling like it did in 2008, it's time to hit that sell button as fast as possible and run for the hills.
Well, you've been saying all along the past few months that we've been talking about this, that there are certain stocks that you hang on to because they are the commodities that everybody buys regularly. A big example there is toiletries, Procter & Gamble. So is that still in effect? Does that still hold, that kind of advice?
Yeah, you can still hold those the things that have repeat business, like chocolate. People tend to eat more chocolate during recessions. They still stock up on toilet paper. More people tend to be working from home, so the video conferencing software works well. And not to mention, right now, kind of the I guess we'll call it the short to intermediate trend is picking up companies that actually make aerospace parts for airplanes. Because a lot of those airplanes have been sitting, idle for several weeks now. They're going to need maintenance. So that's kind of stuff we're playing right now. But those stocks, we don't plan on holding them for, the next 2 years. We look at maybe holding them for the next 6 months to 12 months and then getting out of them and getting in something else.
All right, so you're still holding on to stocks, some of them. Some of them you're dumping and holding on to others, the better prospects you're holding on to.
Correct, yep.
Okay. Mark Collinsworth of Vere Global, thanks once again for some financial analysis in a crazy era on Wall Street. Thanks, Mark.